In less than the time it takes to watch a movie, $1 trillion disappeared from the stock market. Not stolen, not hidden, not lost to fraud, just erased. In a single afternoon, the wealthiest financial system on earth was brought to its knees. Traders wept on the floor, executives stared at screens in disbelief, and ordinary investors watched their savings dissolve in real time. This is the story of Black Monday, October 19, 1987, the single most destructive day in the history of the American stock market, and the lessons it left behind that the world still hasn't fully learned. The early 1980s were a time of financial rebirth in America. President Ronald Reagan came to power in 1981, promising a new era, lower taxes, deregulation, and less government interference in business. Wall Street embraced the vision completely. The Dow Jones Industrial Average climbed from just 776 points in August of 1982 to a peak of 2,722 points by late August 1987. That is a gain of over 250% in just 5 years. Investors were not just optimistic, they were intoxicated. The word on every trading floor was simple: the good times were here to stay. But while the celebration raged, 3 dangerous forces were quietly building beneath the surface. The first, the Federal Reserve had been steadily raising interest rates. Higher interest rates make bonds more attractive than stocks, and smart money was noticing. The second, America's trade deficit was ballooning out of control. Foreign investors were growing nervous about the value of the dollar. And the third danger, the most invisible and the most deadly, was a financial product called portfolio insurance. Portfolio insurance was a computer-driven strategy sold to institutions as a safety net. If the market starts falling, the algorithm automatically sells futures contracts to offset losses. In theory, it was brilliant. In practice, it was a time bomb. It had created a hidden tripwire running beneath the entire market. And nobody, not regulators, not fund managers, not the Federal Reserve, fully understood what would happen when that tripwire was pulled. The first warning shots came during the week of October 12, 1987. On Wednesday, the 14th, the Dow dropped 95 points in a single session. On Thursday, it dropped another 57 points. By Friday, the market had shed nearly 5% across the week. Over the weekend, sell orders piled up at every major brokerage in the country. Fund managers worked through Saturday and Sunday preparing massive sell instructions to fire the moment the market opened on Monday morning. The stage was set, the tripwire was primed, and nobody could stop what was coming. Monday, October 19, 1987. The opening bell rang at 9:30 a.m. What followed was unlike anything Wall Street had ever witnessed. The sell orders accumulated over the weekend hit the market like a wall of water. Within 30 minutes, the Dow had already fallen over 100 points. But that was only the beginning. As prices fell, the portfolio insurance algorithms did exactly what they were designed to do. They began selling, automatically, relentlessly, and every sale pushed prices lower, which triggered more automatic selling, which pushed prices lower still. A feedback loop. A mechanical panic that no human hand could stop. By 11 a.m., the Dow had already shed 200 points. By noon, trading systems were overwhelmed. The ticker tape ran 2 hours behind. Traders were making decisions blind, selling into a market they couldn't even see. By 2 p.m., the Dow had plunged past 400 points of losses. The phones at the New York Stock Exchange were completely jammed. The futures markets in Chicago were in total collapse. Traders on the floor had stopped shouting. Some stood silent. Some wept. When the closing bell rang at 4 p.m., the damage was complete. The Dow Jones Industrial Average had fallen 508 points, a collapse of 22.6% in a single trading day. For context, the crash of 1929 that launched the Great Depression. saw a single-day drop of just 12.8%. Black Monday was nearly double that. The destruction did not stop at the American border. As news of the collapse spread, stock markets around the world fell in sympathy. London's market dropped over 26% across 2 days. Hong Kong's Hang Seng Index lost nearly 46% across the month. Australian, Canadian, and European markets all suffered historic losses. The total worldwide damage was estimated at over $1 trillion, wiped from the world's collective wealth in a matter of days. Banks were nervous. Credit was tightening. The world held its breath. The morning after, Alan Greenspan, Federal Reserve Chairman for just 2 months, issued a statement of just one sentence. The Federal Reserve affirmed its readiness to serve as a source of liquidity to support the economic and financial system. That single sentence was enough. Slowly, buyers began to return. Within weeks, stability returned. Within 2 years, the Dow had fully recovered. But the world had changed in ways that could not be undone. Circuit breakers were introduced. Automatic trading halts triggered whenever markets fall too fast. The role of algorithmic trading was questioned publicly for the first time. New rules were put in place to slow the feedback loops that had turned a bad week into a catastrophe. And yet, the fundamental forces that caused Black Monday have never gone away. In 2000, the dot-com bubble burst, and the Nasdaq lost 78% of its value. In 2008, the global financial crisis wiped trillions from markets worldwide. In 2020, COVID-19 sent the Dow plunging 37% in just 5 weeks. Each time, the crash came faster than anyone expected. Each time, the human cost was devastating. What Black Monday truly revealed is something every investor needs to remember. Markets are not rational systems. They are amplifiers of human emotion. When fear takes hold, it spreads faster than any algorithm can contain. $1 trillion vanished on October 19th, 1987. The question is not whether it can happen again. The question is whether we will be ready when it does. Because if history has taught us anything, the answer, almost certainly, is no.